Hi dear audience, my name is Alexey. We discussed earlier the principles of plotting the horizontal levels as well as their properties. In this video we'll consider the use of pending stop orders when trading a breakout. These are such orders as buy stop and sell stop. Now by several examples I will demonstrate the advantages and disadvantages of their use. First of all, let's examine what is a pending stop order. Buy stop order allows you to buy an asset at a price higher than the current one if the market is rising. Sell stop order is to sell a financial instrument below the current price if the market is falling. Many traders, understanding the main properties of the levels, try to enter the market without waiting for the candle closing in case of the level breakout, and open a buy position if the price has been during some time above the upper border of the resistance level or below the lower border of the support level. Let's examine several examples. We will start the market analysis with the euro to dollar currency pair. In September 2016, the support level was formed on the fact of the bull candle closing on September 22nd. The lower border of the level is plotted according to the shadow of a bull candle. The upper border is plotted on its body. The prices are 1.1124 and 1.1151. Let's paint out the level borders with a rectangle. The market breaks through the support level closing much lower. This is the obvious level breakout, after which the price continues to decline. In this case, we can see a breakout signal success. After an active decline, an aggressive and deep correction begins, which is 60–70% of the impulse length. The level that was a support level turns into the resistance now. For the convenience of perception, I will underline the upper border of the level because there was practically no shadow. After two bear candles closing, the resistance level was formed. Now I suggest looking at how the price was moving during the next day. The market was close enough to the resistance level. The price movement up and close above the level will give us the opportunity to look for a buy entry point on the daily time frame or on smaller time frames. If the price is above the level, some traders tend to open the position at this moment, using the pending stop orders. This is quite an aggressive approach, but if the trend continues right after the breakout, they get a favorable entry price. Since the upper border of the level is 1.1140, we can assume that a significant number of orders were opened at prices of 1.1150, 1.1160, and so on up to 1.1290. There were both stop-loss defense orders and pending buy-stop orders. If you open a position above the upper border of the resistance, you should understand it's a risky idea, since there hasn't been an effect of the candle closing above the level yet. We can see that by the end of the day, the market closed much lower those marks where it was before. The candle size is about 400 points. Traders who opened buy positions above the level by means of pending stop orders turned out to be in a delicate situation, since it's impossible to place a reliable stop-loss order in such situation, as it turns out to be too big. In order to consider such a position to be justified, stop-loss should be short. Young traders in such situations often try to sit out the drawdown, hoping that the market will go in the right direction. You need to understand that this behavior has nothing to do with trading. Let's come back to the example. The market dropped down. The price was declining until the end of December. This is an example of how dangerous it can be to enter the market before the fact of the level breakout. That is, before the obvious close of a breakout candle. The example we have examined is not a breakout, but only testing the level, which we talked about in previous videos. There is another prime example on this currency pair. After the upward movement, a bear candle was formed, which overlapped several bull candles, and the support level was formed. This is a clear market reversal from the bottom up. It's possible to plot support levels at such points. After that, the price was falling during 2 days, and as we can see, the market was below the support level about 30-35 points on this back candle. And again, traders who believed that there would be a breakout in the market and opened short positions without waiting for the candle closing got the bear positions open below the support level. After the price moved up, by analogy with the first example, many traders found themselves either in a situation where the position needs to be closed or sit it out. There is no fact of the level breakout, but there is the position open below this level. The entry price is the worst possible. We have examined the way of trading before the fact of the level breakout by the example of the euro to dollar currency pair. We will analyze more actively traded financial instruments such as the pound to yen currency pair and gold, where such approach can have its advantages. In September 2016, the gold market was in a flat for a long time. There were occasional false breakouts. The support level was formed with the borders of $1,306, $1,309. I will underline this level. Afterwards, the price comes to the level and in this huge candle breaks it through and is closed at $1,267 per troy ounce. The size of this day candle is about $45–50. If we opened a breakout position and waited for the market to close below the level, we would get a signal with a huge stop loss of about $80. This is an unjustifiably big stop loss even for gold and the daily time frame, because risk management rules will not be met. To get a risk-reward ratio at least 2:1 will be very difficult. Therefore, in this example, there is no entry point at the close. However, if you look for breakout trading possibility around a daily level with the help of a pending sell stop order, or you can determine the entry point on a smaller time frame, you could enter the market at a mark, say, $1,302 or $1,298. In this case, it was possible to obtain a worthy risk-reward ratio, which would allow trading on this financial instrument. In active markets, it can be justified since a trader can make good profits by entering the market at an attractive price with a small stop order. Let's examine one more example. The currency pair is pound to yen. The situation is similar. The market has been in the flat for a long time. The lower border of the support level is 130.06. The upper border is 130.45. After a while, the market comes to the support level and a bear candle is formed. If you wait for the candle to close in this situation, the stop loss will be approximately 470 points. This is a very big stop even for daily. At the same time, when using pending stop orders or searching for entry points on smaller time frames around such key levels, you can get an attractive entry price and a short stop order. The use of breakout pending orders in trading has its pros and cons. You need to understand where they should be applied and where not. If you trade assets that often move linear after the level breakout, the use of such trading concept is justified. If you prefer quieter financial instruments, for example, the euro to dollar currency pair, then you had better wait for the candle to close and only after that make conclusions about the reasonability of entering the market.